Morning, Hugh Lambert from Integral Financial Planning. I want to talk a little bit this morning about the impact of increasing interest rates. So we've seen inflation remain stubbornly high at around 8%. Central banks have a mandate to keep, certainly the ECB has to keep inflation at 2%. So when inflation remains stubbornly high, they look to act, and increasing interest rates is one of the ways that they'll look to curb inflation. The inflationary pressures we're seeing at the moment is a lack of consumer goods coming from China, from manufacturing disruption from COVID lockdowns. It's from sanctions on Russia, which is limiting oil and gas supplies, and it's from a lack of foods and grains from the Ukraine because of the invasion. So I'll put up a graphic shortly, and it'll show the impact of inflation on the US economy over the last 50 years. A number of the big spikes in inflation are from the price of oil, and there's a pink bar which goes underneath the graph moving from left to right, which shows recession. So it does have an impact on the economies. So central banks will look to act. They are looking to increase interest rates probably at every periodic meeting for the foreseeable future. Now, increasing interest rates isn't going to increase the supply of consumer goods or foods or fuels, while it will obviously curb other parts of inflation. So another consideration for central banks is the level of debt, and I'll put up another graphic shortly showing the level of consumer debt alone in the US. That's standing at 16 trillion. The level of debt globally between governments, companies and individuals in 2021 was 300 trillion. So an increase in interest rates is going to have an impact. A lot of that debt will be fixed rate, but taking a local example of individuals looking for mortgages, the cost of mortgages will increase for new mortgages, which means individuals will be able to borrow less, and standard variable rates will go up, and that'll obviously put more financial pressure on people. Other considerations then would also be that the last maybe 10 or 15 years or so, we've seen low interest rates and bond buying has had a big impact on stock markets and property markets. We've seen big increases there. So stopping bond buying and increased interest rates will put pressure on equity markets. So I think what to do is, I think for those with mortgages, if you're in a position to review or to change, I think it might be time to look into that while interest rates are low. It might save some money when other things are getting more expensive. I think for investors and for pension investors who have funds based on the stock markets or direct stocks, I think it's to look at your time horizon. If you're looking at a 10-year time horizon, long-term growth in the stock markets is positive. So I would be mindful of that and keep an eye on your time frame as opposed to short-term stock market volatility, which is unfortunately just part of investing. So I hope you found this of interest. If so, please like and share. Thank you for watching.